I'm Cole Nichols. I'm representing Michigan Tech here at the CFA Research Challenge. I would say that our attention to detail as far as putting the paper and presentation together would be the most important lesson. Just as we looked back at our paper, we found mistakes or little tiny things that we certainly wouldn't want to be in there. I would say the biggest challenge would have to be a limited knowledge of the industry, consumer staple sector in general, not a very interesting sector, so we haven't had a lot of knowledge or haven't had a lot of experience with it. I think so, yeah. I think it was a really good experience. It's a good presentation format, a good panel of judges, tough questions that you might not get a lot of, very often in school. Higher level of questions, certainly, and pushing a higher level of understanding. I just think that after going through the CFA challenge and doing all the steps, it's a huge confidence builder as far as just knowing going forward that you do have the ability to really go out and do it in industry.
You wake up in the morning, you get out of your warm bed, into the cold. If you're from the UP, it's even colder. You shuffle into the kitchen, sit down to your boiled cereal. Undoubtedly, it's Kellogg's. And with your Frosted Flakes and shovel, you're ready to go for a Michigan morning. I'm Brett Ludwig.
I'm Cole Nichols.
I'm Michael Morrison.
And I'm Austin Kutroff. Kellogg's is obviously the industry leader in the cold cereal market. However, they do enjoy other different product lines, such as their savory snacks and frozen food. They are in a fiercely competitive industry, and the largest hesitation we have found with Kellogg's is their large amount of long-term debt. We have established a target price of $61.73 with a premium of 1.56%. With the industry is a very mature industry, allowing limited growth in developed markets, but in emerging markets, there is room for growth. During this whole new current health trend, health craze that we're having in the United States and evolving to the rest of the world, Kellogg's has focused their R&D into providing more health-conscious options. And the majority of their net sales come from North America. However, they do have developed markets in Latin America, Asia Pacific, and Europe.
Kellogg, just like any other company, has investment risks. Some that Austin touched on are they operate in a very competitive market. They have a high level of debt. A couple other risk factors to look at are the supply chain, any possible disruptions, along with the overall quality of the products.
And they've experienced issues with both of those things in the past, as you all know, I'm sure. So I'm going to talk a little bit about the financial analysis. We started with our revenue model, obviously. We projected revenues growing fairly consistently, I would argue. No real change in market share, still roughly 2/3 of sales coming from North America and the remaining third coming from the other markets. This, in our assessment, is due to the fact that they may not be able to penetrate as well in the emerging markets as companies like General Mills or PepsiCo, where General Mills is more of a cost, and PepsiCo is already established there. So we think that in emerging markets, they may see trouble and it could stifle growth. Looking at our revenue model adjustments on the top there, you'll see the revenue model that we began with and our anticipated growth rates. We made some qualitative adjustments based on what we felt might be inappropriate trending above. So in Latin America and Asia Pacific, you can see there, we reduced the growth rate by between 1% and 3%. That is due to pricing power that they've experienced in those regions, and they've seen volume declines, actually. So going forward, we think that if the volume isn't picking up and they don't continue to see the pricing power, they're going to have an issue there. And so on the bottom right there, you can see our final revenue growth by region. That's the revenue model we use to project this. And now Brett will talk a little bit about the income statement.
Thanks, Cole. In regards to the income statement, for two things here, net income and basic earnings per share, you can see in the last couple of years, there's been a decrease. However, with Project K and the savings from that, we assume that it will see consistent growth in the forecasted years. Another issue would be payments off towards their long-term debt, which also just kind of consistently narrow that spread for net income and earnings per share.
So looking at their statement of cash flows here, you can see historically they've had good operating margins, and they have also they've used those operating profits to pay off their financing and investing debt. And then there in 2012, you can see with their acquisition, their big acquisition of Pringles, how they used investing activities to fund that. So going forward, we see them using their operating cash flows to pay off much of the debt that they've taken on. As you can see there, reducing the financing and investing activity debt that they hold. And now Mike's going to talk about the DuPont analysis.
Looking at the DuPont analysis based on Kellogg's historical performance, a few things to touch on are the profit margins, which are the leading in the industry due to premium pricing, the equity multiplier reflective of their leverage, and the above average return on equity.
Now we'll be moving into the valuation part of the presentation. To evaluate Kellogg's, we used a free cash flow evaluation and a relative valuation. For the projected value for the free cash flow model was 61.54, and the projected value for the relative valuation was 62.17, leading together for a target price of 61.73 with the premium, once again, of 1.56.
So as we look just a little closer at the free cash flow valuation, looking at using last year's data, we calculated a beta over the last year with the market of roughly 0.8. We used a market return of around 11% minus the risk-free rate to get our risk premium, and that gave us our cost of equity. Perpetual growth rate going forward, we used 2%. We felt that that was appropriate given how mature the industry is. I mean, obviously in emerging markets there's room, but in places like North America and Europe, they're going to see increasing costs in developed markets and tighter margins. So we thought the growth rate of 2% was appropriate. Looking at the sensitivity analysis, which we believe is really revealing in a lot of ways, obviously a lot is going to have to change in their situation. I mean, you'd have to see a 2% bump in the growth rate or the cost of equity going down by roughly 2% before their equity is really out of whack valuation-wise, which is how we got to our hold valuation. And now Brett's going to talk about relative valuation.
For relative valuation, we used 4 different ratios: price to earnings, price to book, price to sales, and price to cash flows. Indicated on the graph here to the right, the black line shows a historical average. For the price to earnings ratio was 15.5, valuating a target price of $51.51. With price to sales, like price to earnings, is slightly below industry average, coming in at around 1.5. And once again, if you trace the black line, it comes to a target price right around our free cash flow to equity valuation of $61.54. Similar story with price to cash flow, using the average of 14, target price of $68.54. And lastly, price to book, historical average of 9, would currently suggest that Kellogg is undervalued with a target price of $70.48. Overall, each of these relative valuations is kind of a snapshot in time. So to get a better overall picture of the group, we combine them all together equally to better assess the current fundamentals of Kellogg Company.
In regards to corporate governance, Kellogg starts at the top with their senior management and board of directors, following these corporate values to set the tone at the top for the rest of the company. They hold social responsibility in high regard. They are built upon 4 pillars: marketplace, workplace, environment, and community. These are seen in their products and in their building of customer and consumer relationships.
In conclusion, we found a valuation indicative of a hold for Kellogg's. We saw that we used the factors such as their high level of debt, competitive industry, and decreasing statistics to make this valuation. All of our projected valuations were assumed under optimal scenarios, meaning Project K was fully realized, their joint venture with Wilmar was fully realized, and other projects like that completed and brought synergy to the company. If these projects would fall apart, we would obviously, there would be a change in fundamentals, and we would have to reevaluate the company. Thank you for your time. Any questions?
I have a question on the page where you show revenue growth. The revenue model adjustments is the title of the slide, and you do revenue growth by region.
Yep.
You're looking at North America to grow at 5%, Europe at 4%, Latin America at 5%, and Asia Pacific at 8%. Relative to what where their opportunities lie is in the emerging markets, that you said.
Certainly, yeah.
And would that just be entirely almost then driven by what's happening in the Asia Pacific region? I mean, looking at 5% North American revenue growth, 5% Latin American revenue growth, are they that leveraged to Asia Pacific?
I would say yes. They're really banking on on getting a solid position in the Chinese market with their joint venture with Wilmar. We feel that they're placing a lot of leverage, like you said, towards this emerging market to infiltrate corners of that marketplace to get a lot of earnings overall.
Are they planning to sell their current products there?
Yeah, they're trying to introduce most of their current products. During the meeting, they mentioned that it is a slow process since maybe cultural issues and barriers exist. So while that may take some time, we feel that still China and the Chinese and Asian Pacific market would exist the most opportunity for Kellogg.
Looking at these growth rates again,
Yeah.
What's driving the growth in North America and Europe particularly? Because I'm thinking that 85% of their business is in North America, and that's growing at roughly population growth, which is between 1% and 2%. So you've got 5%, which is a lot higher.
Yeah. I mean, when we looked at,
If you could reconcile that also with your terminal growth rate and your assumptions on your free cash flow model.
as far as the 2% growth,
Which
yeah.
I think is far more realistic.
Yeah, it is. I guess for the forecasted period, we saw in Kellogg's statements that they wanted to average between 4% and 5% growth in the North American region. So, I mean, true, that is a fair assumption that where is it going to come from, with populations only growing at 1% or 2%. But also the 2011 and 2012 years, they saw 6% and 8% growth increase. So we think during the economic recession, possibly, people went away from Kellogg's products to General Mills products maybe, or any other, competitor. And they may, if economic conditions continue to improve, they get some of those customers back. The confidence is up, and all of a sudden $1 more for a box of cereal isn't that big of a deal when you're looking between General Mills products or Kellogg's. So, I mean, but that is, that's why we thought that was appropriate, given the historical growth and possible consumer confidence coming back to the product. But
How much of that 11 and 12 growth was driven by the acquisition of Pringles?
I would say relatively a lot of growth. Two of the, for the savory snacks and with Pringles and also frozen foods, that's two other areas in which they would experience a lot of growth in North America.
it's good.
Since the frozen food industry right now, it's very profitable. And they're already somewhat well placed with like the waffles, Eggos, and everything like that. But they're still trying to get further food categories into that segment and see growth there.
So snack food growth is very important to them.
Mm-hmm.
Yeah.
And Pringles, what do they have besides Pringles products in that?
They have the Keebler crackers, Austin's crackers. Those are the big two that come to mind, but I believe that there are still other different products in that segment.
It's mostly concentrated just in the Pringles. Not only does it allow them a snack business globally, but also creates that supply chain for them globally. So they're looking to include other products from other segments into that supply chain. And we feel that growth can come from that with the acquisition. That helps supply chain management as well.
And on your relative analysis of the price to earnings, price to sales, price to cash flow, and the companies that you pick for that universe, how does Kellogg compare growth-wise? They are a leveraged company, and others' debt structure is different than their competitors.
Certainly when we were looking at, certainly when we were looking at relative valuation, that was a concern. Especially when you look at cash flow, for example, they're not growing as much as the rest of the industry average, because there are companies like General Mills, which is growing faster, or PepsiCo that we included, or Nestle, it was included in our analysis. So that is why it only carried a 30% weight. We do think that it still has value, because you can look historically and see, you know, it stays within these bands historically. So we did think that the relative valuation still did have some kind of value. It's why we only weighted it at 30%, or, you know, so every valuation, I guess, was 7.5% of the overall target price, every relative valuation. But yeah, the growth, they grow smaller. They're a bigger established company, and they have to deal with companies like General Mills, who are, or Post, or any other company who tend to be growing faster and maybe should receive a higher, you know, historical average in these ratios, right? I mean, they're growing faster. So certainly we did think about that and talk about that, but we kind of felt that if you look at the 4 evaluations that we got, they're kind of fairly distributed around what the current stock price is and what our free cash flow to equity generated. So we felt that there was still value here, that these are fairly good predictors of where you can see the stock price
That's
going.
rationale why you gave it the weight that you gave it in your
Okay.
analysis.
Go back to your price to earnings slide. Okay, so you're saying that 15.5
Is their historical PE.
is what you want. And looking at your slide over the income statement slide, by 2017, they're still not gonna be at $3 a share.
Oh, as far as earnings?
Yeah, which puts them at, you know, $45 stock. Why isn't this a screaming sell?
It does, I mean,
I guess, like I said, it's only a snapshot in time for a price to earnings ratio. Perhaps there's a little discrepancy between at that time or the industry average versus that we went past a few years versus just recently what they are for price to earnings
How
compared
did you
to.
come up with your estimates here?
for income,
Yeah. You got EPS, right? It's going from,
it's gonna go from roughly $2 and maybe 75 cents
$2
to,
$3. The consensus for fiscal 14 is over $4.
currently.
Yeah.
Yeah, we did, obviously, in after 2012, we forecasted a drop in net income and earnings per share. The reason that when we were building our statement of cash flows, we felt the best way for them going forward would be to address the debt. So if you take a look at that, you'll see a bunch of cash outflows going to pay off their long-term debt, which is probably why these numbers are maybe a little bit lower than the standard. Maybe they wouldn't pay off that level of debt or that amount of debt. But just as we were looking at the company, we felt that that was an appropriate place to kind of put those cash flows that we thought that they would still, they obviously have good operating margins and they generate a ton of revenue. So going forward, we thought it would be ideal for them to put those cash flows towards their long-term debt.
And how much of that growth coming up in 15 through 17 is driven by Project K?
The growth? Well, the net income growth,
In net income?
well, Project K, we assumed through what we understood that it was going to reduce operating costs roughly 20%. And so I guess I'm not 100% sure what amount of this would be due to Project K. Let me think.
Project K is baked into that, into your assumptions.
Yeah, exactly. Like if you look at our, if you have in front of you our statement of, or our, well, it'd be our income statement, sorry. if you look at the operating costs, you'll see that they are decreasing at roughly, we assumed that they would see a 20% decrease with the synergies in the following year that they would realize with Pringles and some of their other food businesses.
What confidence do you have that they're going to actually be able to do that?
That's the, yeah, like Austin said at the end, you know, we assumed fairly optimistic circumstances in our mind. We assumed that they are going to pay off their debt and that they are going to see revenue increases. Certainly, 20% reduction in cost is substantial. So any real change in that, or if they're not able to meet that goal, and that it's an impressive goal, and it, very well they may not meet it, then it could push it towards a sell.
Thank you.
Over. Thank you.
You get-